Hey everyone, and welcome back to The Explainer. Today, we're diving into a literal masterclass in corporate strategy. In a tech world dominated by trillion-dollar giants fighting over AI, one highly specialized player is quietly achieving absolute record-breaking growth by building physical hardware. That company is Garmin. Today, we're breaking down their staggering first quarter of 2026 and the brilliant strategic moat they are using to steal market share right out from under the noses of the biggest companies on Earth.
So here's the roadmap for today's Explainer. We're going to kick things off with those record-breaking financials, move into their multi-segment advantage, talk about how they're squeezing the competition, look at shareholder returns, weigh the risks, and wrap up with the forward outlook. Let's get into it.
All right, Section 1, record-breaking financial growth.
Okay, I want you to anchor on this massive number right here, $1.75 billion. That is Garmin's record consolidated revenue for just the first quarter of 2026. Guys, that's a 14% year-over-year jump. Now, if you thought, inflation or economic headwinds were stopping people from buying premium electronics, yeah, think again. Pushing double-digit top-line growth right now is just a massive signal of consumer demand and, honestly, unshakable pricing power.
But wait, it actually gets better. Because look, growth is great, right? But profitable growth? That's the holy grail. This 30% figure represents the absolute leap in Garmin's first quarter operating income, hitting a record $432 million. And notice how operating income grew at literally more than double the rate of their revenue. That tells us they aren't just shipping more boxes, they're actually making significantly more money on every single device that goes out the door.
And you can see that operational efficiency totally shining through here. Back in Q1 of 2025, operating margins were sitting at 21.7%. Fast forward to Q1 of 2026, they've expanded to 24.6%. But honestly, the real kicker is that figure on the right. A highly impressive 28.10% margin over the trailing 12 months. I mean, for a company building physical hardware, maintaining margins pushing 30% is incredibly rare.
Moving on to Section 2, the multi-segment advantage.
So Garmin's diverse portfolio basically acts like this incredible internal shock absorber. Take a look at the segment data. You'll see the outdoor segment actually dipped by 5%, and auto OEM basically flatlined, just eking out 1% growth. Now for a pure-play outdoor brand, that'd be a disastrous quarter. But for Garmin, the booming fitness, marine, and aviation segments completely picked up the slack. They totally offset those struggles and lifted the whole company to that 14% overall growth we just talked about.
And we really need to zero in on the absolute star of the quarter here, which is the fitness segment. It's skyrocketed by an astonishing 42% year over year, pulling in nearly $577 million. This was heavily driven by massive demand for advanced wearables, like the Forerunner 970 and the Venue 4. It just goes to show that buyers are more than happy to pay premium prices for deeply analytical, serious health tracking. But here's the thing, their moat isn't just fitness trackers. It's this relentless, non-stop innovation pipeline across all their segments. I mean, they snagged best connected device for the Fenix 8 Pro. They rolled out highly specialized gear for golfers and motorcyclists. They even got FAA certification for their aircraft auto-land system. Yes, you heard that right. They make tech that can literally land an airplane. This kind of hyper-specialized innovation creates a massive protective moat that general tech companies just can't easily cross.
All right, let's get into Section 3, squeezing the competition.
This quote right here from CEO Cliff Pemble, this is basically the skeleton key to their entire playbook. He said Garmin is able to take share both above and below us from different players. Keep in mind, the broader global wearables market is only growing at maybe a mid-single-digit rate, around 8%. Yet Garmin's fitness segment just exploded by 42%. That gap? That is pure market share being directly stolen from competitors by using this exact philosophy.
So here's exactly how they execute this squeeze play. From above, they're actively pulling customers away from Apple by offering genuine, deep sports science. We're talking long-term structured training loads and advanced recovery metrics that, frankly, Apple's native ecosystem still kind of struggles with. Then from below, they're beating budget brands like Xiaomi and Huawei. Because sure, a cheap band can count your steps, but it can't offer Garmin's ecosystem quality or that unmatched GPS accuracy. They're essentially squeezing the middle by being the undeniable premium standard.
And once they get those users, they absolutely do not let them go. This is textbook ecosystem lock-in. They're converting casual users into dedicated athletes right there within the Garmin app environment. Think about it. Once you've got 3 solid years of highly personalized VO2 max and running data locked in the Garmin Connect, the idea of switching to another brand becomes basically unthinkable.
Management actually highlighted strong double-digit growth in new user registrations this quarter, which proves this lock-in strategy is executing flawlessly.
Which brings us to Section 4, Shareholder Value and Returns.
Because Garmin is running so profitably, they are generating just a mountain of cash. Their Q1 2026 free cash flow came in at a massive $469 million. You can see the breakdown of how they're using it right here. $174 million went straight out as dividends, $40 million went to stock buybacks, and $255 million was retained for operations and growth. Oh, and let's not forget they also have a total cash pile sitting on the balance sheet of roughly $4.3 billion. Just incredible.
And management is incredibly disciplined about rewarding investors with all that cash. They just announced a brand new $500 million share repurchase program running through December 2028. Plus, they proposed a $4.20 per share annual dividend. Guys, that marks 23 consecutive years of dividend growth. Honestly, whether the broader market goes up or down, Garmin has demonstrated a multi-decade commitment to returning capital to their shareholder.
But, of course, we need to look at the whole picture. Section 5. Risks and market headwinds. Because the threats to this business are definitely substantial, and we can't ignore them. First up is tech giant overlap. As Apple keeps expanding its health features, that competitive gap could definitely narrow. Second is smartphone convergence. As phones get better built-in sensors, some casual users might just abandon watches entirely. Third, you've got global tariff uncertainties, which always pose a risk to complex supply chains. And finally, market saturation. That 5% decline in the outdoor segment we saw earlier, that could signal that premium enthusiasts are holding onto their older devices a bit longer these days.
Furthermore, there are some clear operational drags, specifically in the auto OEM division. That's their built-in automotive tech for car manufacturers. The segment actually posted a $6 million operating loss in Q1. It's being heavily pressured by legacy program roll-offs and accrued warranty costs. Now, while upcoming domain controller shipments for BMW do offer a bit of promise for late 2026, right now, automotive remains a pretty clear drag on their overall profitability.
All right, let's wrap things up with Section 6, the forward outlook. Management knows they have to keep evolving, and they've laid out 3 really clear strategic imperatives moving forward. Step 1, they are actively trying to transition from just a hardware-only model to one that includes highly predictable recurring services. Think things like satellite subscriptions for their InReach devices, or the Kids Bounce 2 smartwatch. Step 2, expanding into actual clinical healthcare, like their exclusive smartwatch partnership with King's College London. And Step 3, relentlessly maintaining that niche innovation leadership where the mass-market tech giants simply don't have the domain expertise. And management clearly believes this playbook is going to work. Showing massive confidence in their strategy and their Q1 performance, Garmin has officially maintained their fiscal year 2026 revenue guidance at a whopping $7.9 billion, alongside pro forma earnings per share of $9.35. So yeah, they are absolutely not backing down from their highly ambitious targets.
Which brings us to the ultimate question we really have to ask ourselves as we wrap up this explainer. The numbers today are absolutely record-breaking, for sure, and their strategy of squeezing the middle is pretty brilliant. But can this David continue to take market share from the Goliaths of the tech world as smartphones and mainstream smartwatches become more and more advanced? It's going to be a fascinating dynamic to watch unfold. Thank you so much for joining me today on The Explainer. Keep learning, keep analyzing, and I'll see you next time.